and do that and make sure the world is working. And with that, I am going to hand over to you. I always do a virtual round of applause because I think it helps people, and you can't physically do it because obviously Nicola can't hear you, but she can me. So I'll now hand over to Nicola with a virtual round of applause. Go, Nicola.
Good morning, everyone. So what we're going to do, like Simon said, today we're going to talk about cash. So I'm going to share a presentation with you. So hopefully you can all see my screen now.
Yep, I've got it, Nicola. Yep.
Perfect. So obviously what with everything that's happening with COVID, coronavirus, lockdown, all of these words we're hearing all of the time, the worry is about the recession that is likely to follow. So what we're going to do, we're going to talk through what happens. So next week we'll talk about profits, but this week we're going to focus on cash. So if we start with looking at the way the graphs tend to work for a recession, so you can understand. So going up here, we have money. So low is when obviously there's less money in the economy, high, there's more money, and then time is going across. So what was initially told to us when we first went into lockdown, economies and the government expected that what would happen is in March, everyone closed for lockdown. So there was a severe drop here in the economy. And then the expectation was the furlough money would be in place. And up until June, that would be sort of when furlough is likely to come back and people are going back to work, all the way back to September when it's normal. So people are back to school, everything was open. So the expectation was we'd see this U shape, which is known as a quick recession, just a bit of a dip and then back up. Now, in reality, a recession doesn't usually look like that at all. A recession usually slowly declines, which as you can see here would have happened in March, and tails off. So we don't necessarily know when it's going to come to an end. So at this point, the government will inject money. They might do quantitative easing where they print money to get more money into businesses, into the economy. And this is sort of a typical recession. Now, as we all know, this isn't typical at all. So what's actually happening at this time is we had the severe drop when businesses were asked to close, people were asked to stay home. So that's March right at the top. And as it comes down, it's beginning to, as things are beginning to open, June, July, August. So we've seen next month that businesses are looking to open shops that are non-essential. So it's beginning to pick back up again. However, the thing to bear in mind is we expect that at Q1, Q2 next year, so when January, February, March time, that it's likely to dip back down again and go into what we call the normal recession, the previous graph. So the reason for this is people are obviously using the help provided by the government, so deferring their taxes such as their VAT, corporation tax, self-assessment, PAYE. They might have taken a bounce back loan or a business interruption loan, and those are payable obviously the first 12 months. There's no repayments, but they begin to come back in. You've also got the fact that obviously you've got possible redundancies as the furlough scheme runs out, and rent quarters that will be due 25th of December, 25th of March usually. So there's going to be an outlay of cash that's needed at the beginning of January, February, March. And the worry is that if we're not aware of this graph here, the worry is that we trade thinking we're coming out of it, everything's going to be nice and rosy again, and we forget that that second dip is going to happen. So what we would advise is to bear this graph in mind when you're making decisions now. So if you're looking at unfurloughing staff and unfurloughing your team members, and they're here in June and they're beginning to be unfurloughed, bear in mind if that second dip happens and you then needed to make someone redundant, for example, is it better to make them redundant now, or is it better, can you weather that storm? So what we're going to do in this presentation is talk through cash, and just bear in mind this graph and think when you make your decisions how you can put the cash and this idea together to make sure you're making the decisions that are right for your business. Okay, so there's a common phrase: if you always do what you have always done, you will always get what you have always got, or less. So economies move, the technology moves, your competitors move constantly. So if you stay where you always are, you actually end up falling behind instead of moving forward. So we're going to work with on cash today, different systems you can put in place to help keep cash flow in your business. So what we will do, we'll talk through a few different options, and I've got a whole array of ideas that we can work through. But just bear in mind, if you stay with where you always are, you actually go backwards, not stay consistent. So if we look at Jeremy Clarkson, for example, Jeremy Clarkson writes a column in the Sunday Times about motors normally. So cars obviously is his thing. But with people being asked to stay home, the car and the motor industry slowing right down, there's less going on in the motoring industry. So he can't really, he's not got the level of content that he had previously to fill that column. So Jeremy Clarkson has what we call pivoted himself. So he's now writing a column about farming. So Jeremy Clarkson has a farm, and he's decided to change his Sunday Times column to be about his farm and the farming industry. And this is obviously still massively relevant because we all need farmers for our food, supplies, produce. So obviously by doing this, Jeremy Clarkson is still relevant, still providing content, still obviously in the eye and topical. And so how this can apply to you, what can you do in your business? How can you pivot your business? So some examples that I've seen. We've all probably seen the videos and the photos on Facebook of restaurants that used to just sit at home. You go into the restaurant, and obviously we can't do that anymore, which is absolutely devastating for me because I love pizza bites at Prezzo. But what can we do instead? Restaurants are now doing delivery service, or they're doing, you turn up in your car and they give you a number when you phone up for your order, and they obviously deliver it car to car. So that allows them to keep within social distancing, but still doing what they're good at. You've also got engineering. So we know of some people who do engineering for motorsports. Again, just like poor Jeremy here, motorsports has gone quiet. So in terms of engineering for motorsports, the business has just gone dramatically down because they don't need that, because motorsport can't race. So they don't need the engineering. So some businesses in engineering have pivoted and they're doing different types of engineering. So an example is civil engineering, which is still required and there's still projects out there for. So by pivoting, they're still relevant. And then you've also got examples of if you were previously in a shop, or if you were doing providing lessons to people face to face, can you pivot that? Can you go online on a website? Can you use Zoom? Can you do video recordings? So there's a whole host there that you can work with to think about how to keep your business going. But what we'll do next week, we'll come more onto the way that you can operate your business to keep your profits moving too. So this poor little pig sat in bed, he needs to think about how he can operate in the most efficient way to get that cash into his business. So obviously what we're going to do is talk about cash, because if we run out of cash and we can't afford to pay our taxes, no one wants to see Liz working in McDonald's. It's just not a good thing. So when we're talking about cash, we need to follow the expression, turnover is for vanity, profit is for sanity, and cash is king. So the turnover profit points we'll pick up on Tuesday. But cash is king is a huge statement. So 80% of small businesses that fail is because of cash flow. That's a huge number. So what we need to do, we need to look at how we can make your cash better within your business, how we can help your cash flow. So in order to do that, the first thing you need to do is know where you currently stand. Because if you don't know where you stand, how do you know if you've got a problem or not? So the first thing to do with that is to do a cash flow forecast. So there are tons of different pieces of software out there that can do it. But for now, the way we would recommend right now, just to get you started, get a feel for it and work out how it works, is we have an Excel template. So I'm going to talk you through how this works. But what we will do is we will put this link on our feedback form that comes to you. So if you want a copy of this template, just tick the link and then we will send this out to you. But I'll explain how it works now so that you can obviously refer back to this if required. So the idea of a cash flow forecast is exactly as it sounds. We are going to predict your cash in your business. So we recommend doing this over 12 weeks. So you've got week 1 all the way through to 12. And if you look at it on a weekly basis, then it allows you to see where the gaps are. So the beginning of the template is laid out exactly like this. And you'll see 2 sections. So the top is your income. So your income is any money that's coming into you. And this is the actual movement of cash. So this includes VAT if you're VAT registered. This includes the VAT because the cash is actually coming into your bank. Similarly, with outgoings, it includes the VAT that you pay out. So when we go through this, what we need to look at is customers at the top for incomings. So you have customer A, B, C, D, and you can split that how you want. But let's pretend that we're going to list each customer in this example. So obviously, I know it's bespoke to your industry. So if you had online sales, you might classify that in a different way. You might have different platforms. But let's pretend we're going to just do A, B, C, D. We've got 4 main customers. And then outgoings, similarly, we've got a few main suppliers, but we also then have our overheads. So wages, rates, rent, phone, VAT, PAYE, these are all different payments that we will part with from our bank and drawings so we can pay ourselves, so we can afford to carry on living our life, having our house, paying for food, etc. So when you lay all of those out down the side, and obviously you can always add to it, you then need to start to forecast your numbers. So what that means is customer A, we want to look at when customer A is likely to bring money into our business. So, and we'll talk through the way you can get customers and increase your cash flow from customers in a minute. But what this means is if customer A has an invoice that's due for payment in week 1, then you would put it in week 1 because it's not when the invoice is raised, it's when the cash is coming through the door. So we can see in week 1 in this example, you've got customer A is going to pay you £1,000, but you also need to pay supplier A 400 and you need to take £500 to live on. And therefore you have right at the bottom, net cash inflow of £100. And you can see that goes on week by week. If we stop and look at week 4 for a moment, week 4 has £500 coming in from one customer. However, the wages need to go out in week 4. So £5,000 for wages and £500 for your drawing, so you can obviously continue to pay yourself. Then what happens is you're actually negative, if you can see at the bottom here, that is negative 4,500. So the worry would be if you didn't have cash in the bank at that point, that negative, you might struggle to pay that. So we know that that's a problematic week. So to see the full picture, we then put the bank balance at the bottom. So you can see the opening week, the balance at bank at the beginning of week 1 is £10,000. And then the numbers we've tweaked ever so slightly, but that's then got a cash amount coming in of £800 in total. So £1,000, oh no, sorry, that's negative, can't see my minus, sorry. You've got £1,000 coming in, 1,800 going out. So that £10,000 in your bank is expected to go down to £9,200. And that's how the second week opens. So it continues on like that. So a few things to note when doing a cash flow forecast is firstly, make sure that you are keeping it up to date. So week 1 to 12, it's very easy for people to do week 1 and tick all the way along to week 8 and then realise they've only got 4 more weeks showing. So keep a 12 weeks rolling because 3 months is always a good amount to look at. And it's also common, people often only do a cash flow forecast when they're in trouble and when there's a problem with their cash flow. But we would recommend that you continuously do this because it's just good practice. It helps you to schedule your work. It helps you to look at your suppliers and who you're paying and what you're paying and when. So it just helps you make business decisions. And you've also got the point that you can tweak the numbers. So this is obviously on a spreadsheet. So you could play with those numbers. Sorry, let's go back. You could play with these numbers and show that you could, for example, the loan repayments of 1,000, let's say you wanted to pay that off more, you could change that number to 2,000 and see if your cash flow would allow you to do so. So it gives you the flexibility to play with the numbers as well. So that's the cash flow forecast. So if you prepare that, that will allow you to see where you stand at the moment. And obviously, if you needed help with preparing that, just give us a shout and we will obviously be more than happy to help you prepare a cash flow forecast and talk you through it in more detail for your business perspective. So that's your cash flow forecast. So the next point that we need to look at
I've just got a couple of questions, Nicola. Peter's asked, can I have a copy of the spreadsheet? And so there'll be a feedback form at the end. You just tick the box on the feedback form and we'll email it out to you. And then the second question was around personal finances. So should he be doing it for personal expenses as well as business?
Yeah, that's a great question. So yeah, we would recommend that you obviously do it for your business because you need to see your business where it is, but 100% recommend doing it personally too, because that line of drawings, £500 per week, if you can understand where your personal cash is going, you might not need to take £500 per week. And then that can obviously have a knock-on impact into your business. So business and personal should be done side by side. And that's a good idea with anything you do with your business, because obviously we all set the businesses up to allow a personal goal to be achieved. So always look at business and personal side by side. So yeah, great idea.
Brilliant, thank you. And I know you're going to cover this in a minute in a little bit more detail, but there's a website, the Money Advice Service, which I'll put in the chat box for everybody to see. It's got a personal budget planner in that we've used with some customers that enables you to think about stuff that you need to have on your personal stuff. So I'll pop that in the chat box, a URL in the chat box now, so you can have a look. Brilliant, thank you, Nicola.
Perfect, thank you. Okay, so that's the way you do your cash flow, and that's how you know where you stand. But now we need to look at what can you actually do to improve that, because it's great knowing where you stand, but now we need to make that greater for you as possible, as much and as efficiently as possible. So there are 7 main sources of where you can get cash from for your business. So this list is in order of preference, and we're going to work through this list item by item. So the first is your customers, then your suppliers, following that, the government. Lenders is an obvious one, but that's 4th down on the list, and we'll explain why when we get there. Assets and investments, investors, and finally, family. So that's at the bottom for a good reason, but we'll come back to that. So we're going to start by looking at customers. So how can you get your customers to pay you quicker? So it's a common sort of theme with most small businesses that there's not really a particular process to get your debts collected. And that's quite common. It tends to be, and when we talk to business owners, it tends to be that, well, when I need cash, I'll phone up my customers. But if you put a simple process in place to allow you to get your sales invoices collected and the money and the cash coming through the door, then it is a lot more likely that you will get paid quicker. So obviously, we're going to talk you through now a simple system you can use. So the first one is to credit check. So if you're supplying goods or products or services to a customer, to another business, and you're going to give them credit terms, you should credit check them really, because although credit check is always looking back at historic accounts, so bear in mind things might have changed a little bit since then, it's not gospel. It gives you a good indication of, is this business able to pay its debts? Is it likely to be able to pay me? So if it fails a credit check, then that's the potential risk that you might not want to give them credit terms, or you might want to change the way you deal with them compared to other customers. So there's obviously tons of providers out there, but Experian, Credit Safe are all different providers that you can use to do this service. So when you raise an invoice, so you raise your sales invoice on day 1, and think about your credit terms. So most people will do 30 days of credit terms. So that it tends to just be the standard, but ask yourself why. Why do you think you do 30 days? If that's all you believe you can get away with, then that's fine. It tends to be conventional. However, if you have the capability to make that less, 21 days, 14 days, 7 days, then that obviously gets cash through your door quicker. So I know it's sometimes a bit more difficult to change it with existing customers, but you could think about new customers coming on, or if you've credit checked someone, you could reduce their credit terms or their credit limit. So there's a number of things you can do, but just think about your terms and what they actually mean and how you came up with them. So following that, 1 week later, we would advise you to phone the customer and just check they received that invoice. Because obviously a really common excuse or answer you hear when you say, oh, we've not been paid our invoice was, oh, I never received it. So if you check 1 week after sending it that they actually received that invoice, it's not gone in their junk, it's not been lost in the post, it didn't go to the wrong person, then you can make sure they've got it and you're increasing your chances of being paid on time already. So following that, we then look at 1 week before the payment's due. So we've done this based on 30 days payment. So day 23, a week before payment's due. So what you would do Again, pick up the phone, always the best way to communicate. So pick up the phone and speak to the customer. Are they likely to be paying you? So the conversation would be, hi, we've got an invoice outstanding with you that's due, not due till next week, but I was just double checking, you've got that invoice, you've got the bank details, you've got everything you require in order to pay that. And it's just bringing it to the front of their mind again to make sure that you don't get missed off a list, they don't forget you. So that's another great way to increase your chance of being paid on time or quicker. So then, if they miss payment, if day 30 comes, no payment in the bank, we advise you wait 2 days and then chase that payment. So there's day 32 for a chase. If that's still not with you a week later, there's another chase. And if that's not with you a week later, there's another chase. So 3 payment chases there. And to keep a bit of variety, we recommend doing different forms of chasing. So you might want to do a phone call, you might want to do an email, you might be dropping by their office for something and you might want to go in and mention it. But 3 different types of chasing, and obviously keep a record that you've done those chases on your system. So they're your 3 chases. And then you also might want to consider on that final chase, notifying them that you have the right to charge interest. So if you have a debt that is overdue, then what you can do on day later on when it's overdue, you can choose to charge them interest. So that is at 8% of the overdue amount plus the Bank of England rate, which I know isn't great right now, but you can obviously charge 8.1% of interest at the moment. And sometimes even just saying it can obviously begin to spark in their head, oh, this is getting more serious. But with anything you do with customers and sales and debts or any part of business really, you should mean what you say and say what you mean. So obviously, if you're going to say you're going to do it, at that point, you should charge interest if they're going to pay you. Because if you just keep threatening it, they'll just think, oh, we can get away with this. So actually, if you say it, do it. And then that brings us on nicely to the final point. So if 1 week later, they're still not paying you, at that point, you do a 7-day warning letter that you're going to escalate this to court. So our recommendation, again, to prove that you mean what you say, is to get a copy of the court papers, fill them out, take a copy of that and send it to the customer with the final letter, just explaining that we're now at day 53, so you're 23 days overdue in payment. This is a letter with a copy of the court papers that we're going to send unless we receive payment within 7 days. And it just shows that you mean what you're saying. So that is a simple process that you can follow. You can diarise that, you can keep a copy of it, but it just allows you to increase your chances of getting your cash through the door. So what if you didn't even have debts? What if you changed the way you got cash through your door so you didn't even have to follow this process? So how can we do that? There's a number of different ways. So the first is direct debits. So we personally use Go Cardless. So what that means is instead of someone paying an accounts bill at the end of the year or any kind of whatever product service you're in, instead of someone paying it when the work is all complete, why not split that payment into monthly payments or into smaller, like more regular frequencies throughout? So if you've got a £2,400 annual bill, why not split it into 12 lots of 200? And then you've got cash coming through month by month. They're only parting with cash month by month, so it's not as big an outlay for them. So that's your direct debit that you can put in place. Furthermore to that, you also have standing orders. Very, very similar to direct debits, except with a direct debit mandate, you have the capability to change the amount of direct debit. So you think about your mobile phone. Your mobile phone bill is probably linked to direct debit. And if you've used too many calls in that month, they'll put an extra bump on the end and they just have the capability to do so. If there's standing order, that doesn't happen. You just pay what you pay. So it's less flexible than direct debit, but it's still getting your cash into your business more regularly. Next, you could have pay up front. So obviously with some bits of work, people might ask for payment in advance, or they might ask for stage payments. So stage payments is a really common one for people in construction. So if you're doing a build on a house, you might ask for a certain payment up front and a certain payment when the foundations are down, payment when the walls are up, payment when the roof's on, etc., until you've got all your money. But why should that just stay with construction? could your business use stage payments in its own right? So if you're engineering or if you're designing and manufacturing, could you take payments on first design, after the amendments of the design, once the manufacturer's done, after any amendments to that, and then final payment? Could that work for you? So just think about how you could use that within your business. Deposits, again, similar to stage payments. Could you take a deposit to allow the business to basically secure that you're going to do the work? So you don't want to start doing work and then they go, oh, we changed our mind, we're going with someone else. So if you took a deposit to guarantee that, it just helps you again with cash flow as well as keeping the business. And finally, early payment discounts. So again, this is quite common, but just be careful with early payment discounts, because if I said to you, your payment is due by the end of June, but if you pay me middle of June, I'll knock 2% off your bill. The thing to think about there, it might get my cash in quicker, but obviously I'm going to get less. And that percentage, that 2%, is usually complete profit margin at that point, based on obviously where your profit margin should be, which we'll come to next week. But your 2% will be coming completely off your profit. So it's great to get cash in, but you don't want to sacrifice your profit at the same time. So use that one with caution. Just be wary on that. So that is the customers. Are there any questions on that bit, Simon?
Yeah, I've just got a question from Susan on the direct debits.
Yeah.
I asked my bank about collecting direct debits and they told me that I wasn't big enough, something about my balance sheet. Has that changed?
Not that I'm aware of. If we direct debit, Simon, are you aware of an upper limit on it?
Well, once upon a time, in the good old days, I know if you went to one of the high street banks, they used to have, I think it was 500,000 net asset position before they would allow you to think about collecting direct debits.
Yeah.
But that is been, I won't say it's been relaxed, but there are providers out there now, like Go Cardless, for example, that accept some of that responsibility. So it's far easier to set up a direct debit system using Go Cardless through something like Xero or QuickBooks Online or something like that in order for you to be able to collect the debts. So if that's something that Susan wants to do, if you have a conversation with her, Susan, I'm pretty sure we can, if you put something on the feedback form, I'm pretty sure we can point you in the right direction on that.
Yeah. Any others?
No, that's it at the moment. Thank you, Nicola.
Okay. So the next section, so customers being the top of the list, that is your first point of call. That is where you should start to begin to get cash moving through your business quicker. The next step is suppliers. So there's different stages to this. So firstly, review everything that comes out of your bank. So your direct debits, standing orders, look at what you're spending. Do you know what you're spending? So we've had people previously that have had, up until the end of last year, they were paying for a fax machine and they couldn't remember the last time they used a fax machine. So are you paying for photocopies you don't have? Do you use the maintenance? Everything you're paying for, are you using it? Are you getting value from it? So the first point, and again, a bit like the question earlier, we'd recommend doing this for your business, but also for you personally, because it's very common that people will be paying for Netflix and never use it. Disney Plus, how many TV subscriptions are there now? So they're paying for all of those and they never use them. So review personal and business spend and make sure it's relevant, make sure you're getting value for it. So that's point one. The next point is, can you pay less for it? So when you're doing that supplier check and going through those bank statements, are you paying more than you should? Can you do anything to reduce that? So I'll give you an example with us, for example. We provide accounts for people, and obviously it's the way we do our quotes, they're built up based on the quality of records. So if a customer can improve their bookkeeping, then we can reduce their price. So obviously if you've got the capability or the time or the flexibility to spend a bit of time learning Xero or learning a new system, then your bookkeeping will improve and therefore you could look at reducing your accounts fee. And that's just for us. If you thought about doing that with every supplier, every provider you have, then how could you do it? What could you do to bring those prices down that you're paying? So that's another one. And then finally, pay them slower. Now, a word of warning on this, because obviously business relationships are really important. So if you are struggling to make payment, if you can't make payment, it's worth picking up the phone to them first and picking up the phone to that supplier and saying, look, my cash flow is not great right now, I'm struggling to make payment, is there any way we can extend my terms by 2 weeks, or I can pay you at this point, can I pay you then? So just be careful. I wouldn't recommend just not paying someone. I'd rather someone have a communication. But at that point, it is another option. If you can pay someone slower or extend your credit terms with a supplier, then obviously it helps you keep your cash in your business for a little bit longer. So they are the suppliers. We're going to move on to government next, unless there's any questions there.
No, there's no questions on suppliers, Nicola. Thank you.
Perfect. So government. So the government is obviously got a number of different points to it. So we're going to work through one by one. So government tax obviously comes to mind. So what can you do to pay less tax? There's a few different, well, there's plenty of different options here. So we've actually got 66 secrets the tax man doesn't want you to know. So that's a checklist that we will work through with you and sort of ensure that it's up to date. So if you want a copy of that, that will be on the feedback form. So tick the box and we'll obviously send you a copy out. However, there are also research and development claims. So R&D is a huge area of tax that often gets overlooked. People think R&D should be scientists in lab coats with Bunsen burners and goggles on and stuff, which isn't true. R&D is huge in so many different businesses. So what it actually means is if you're doing something that extends the field of science or technology, then you can consider claiming R&D tax relief. So research and development tax relief, what does that mean? That means that you would have sales on your profit and loss, and at the moment you take off your expenses. So let's pretend sales were 50 grand, expenses 20 grand, and at the moment you've got a profit of 30 grand. But if in that you had 10 grand of R&D spend, so you spent money developing a new product that was going to make something more efficient or going to be faster, going to allow someone to do something better, you actually get 130% of that on top. So it would take the 10 grand off to bring you to your 30 grand profit, but then it would also, that 10 grand of R&D, you'd also get another 130% of that. So you get another 13 grand off of your profits for tax purposes. So you're paying a lot less tax, which is obviously a great thing. So what does it mean? How do you know if you do R&D? So it's kind of linked to the words. So are you making something that is making something faster, cheaper, better, more, still sort of an word, efficient? So things that you're doing to improve a process or improve a product. So I will give you some examples. You might be doing, obviously, building a product that is new, exciting, it's new to the market, and obviously that's an obvious R&D. However, it might be that you are linking your back office system. So you might have all these different bits of software, and you might have bought a bespoke bit of software or paid someone to make it bespoke, and they are spending time connecting all of your different pieces of software to that bespoke one. That also would count as R&D. So obviously we'll go through, if you want help with this, we can talk you through the eligibility and making sure it's worthwhile and all the complete little dots and noughts and crosses and ticks and everything is all done. But that is an example of R&D that I have seen used before. Construction, so where there's been, for example, a flat block or an existing building and they're building new flats on the top. There was the logistics of how do they get the materials up there? How do they make it so the existing foundations can continue to uphold that and withstand it? There was loads of complications there that they had to spend time developing, researching, understanding, trying and testing it, prototypes. So all areas like that are research and development. So if your business if you ever sit there and you sort of scratch your head and think, how do I do this? And it's not available, and you can't just go to Google or you can't go to a competent professional and they say to you, oh yeah, you just do this. If that isn't possible and you have to sit and work through something, you might be eligible to claim R&D tax relief. So if that's a possibility, feel free to have a chat with us, pick up the phone, and we will seek to understand what you've been doing, work through it, what the amounts are that you could look to claim, and obviously help you build a claim together to do that. So there are your taxes, but also think about when you pay your tax. So we've had VAT and self-assessment, the July payment, were both automatically able to be deferred initially. But now we've got the next VAT quarter, won't be automatic. And you've also got things like PAYE, CIS, corporation tax. So if all of these payments become due, if you can't afford to pay them, you can, or we can on your behalf, speak to HMRC to put what's called a time to pay arrangement in place. So what that means is that you say to HMRC, look, I can't afford to pay right now, but what I'll do is I will pay you in the future. I expect I'll be able to pay you then, and you can obviously use your cash flow to help you work out when you will pay. Now, as long as you picked up the phone and told them, they'll be aware and they'll obviously agree that, or you seek to then agree that, come to an understanding and an agreement. But bear in mind, they do add interest. So the current interest rate is 2.6%. So they will add interest on late paid, but it's better to make them aware than, again, just not say anything. And obviously, then you'll get all those letters telling you that red writing, we need this money. So it's better to pick up the phone and talk to them. The next one are the grants. So we're aware, and we've done previous sessions on this before, so they'll all be on our YouTube, or you can contact afterwards if you want to talk through these. But there's been grants obviously released for coronavirus. So tons of different ones linked to your industry sector or where your property is, et cetera, et cetera. But there's also grants throughout the year, just constantly. There's always different grants available. So what we'll do, we'll share a link in the chat box where you can look at what grants are available, because obviously that continually needs updating and needs looking at. So there's a website that will list them. But there are different grants. So if you're, for example, I've had someone previously who was developing an old building, and they managed to get a grant for doing that because they were sort of restoring it back. So it's not just they were doing it to use it, obviously, within their business. It's not just the coronavirus grants that are out there. There are other grants available, and it's always worth checking, are you eligible for any? So they are the grants. Extending your year end. So this is another one that is kind of often gets overlooked, to be honest. It's not that difficult to do. So you might have a year end of December 2019, and you might have made really good profits through that 12 months of January to December 2019. So at that point, obviously you would normally say, here's my books, here's my records, my zero's up to date, whatever it is to your accountant. And they will say, okay, let's prepare some accounts. And you have 9 months and a day to do those accounts and corporation tax return, 9 months and a day to pay that corporation tax, sorry. So the payment would still be due 1st of October, but if you suddenly went into loss making, January, February, March, April, May, with all of this that's happening, you can extend your year end to 18 months. So you could technically extend, so you've got from the 1st of January 2019 to the 30th of June 2020. So you would still need to pay your tax on the 1st of October, but you could look at, instead of just being taxed such a high amount on profits, if there's been losses too, could you offset those losses against that profit and therefore bring down the amount you owe the tax man instead of waiting until December 2020 year end's done, the accounts have been prepared, and then obviously then getting your tax relief. So that's a really great one to do. And if you want to, obviously, if you're an existing customer, feel free to talk to your manager, to your point of contact about doing that, unless obviously we'll still be in contact with you. But if you want to do that in plenty of time before your accounts come up to date, then feel free to do that, although we will have that conversation with you if we believe it's relevant. If we're not your accountant, you can still feel free to pick up the phone anyway and ask us, is that likely to work for you? And we'll be more than happy to help. And then the final one on this is just be aware of your overdrawn director's loan account. So as much as the government has obviously given a lot of grants away, just be aware that people might take the grants, might take the loans, and then use them personally. So if you're a limited company and you've got cash in your business that you take out for personal use, so you might be drawing money. We saw on that cash flow, £500 per week being drawn. If you draw money, usually what happens is you might have a small salary as the typical setup of 8.5, just more than that, grand a year. And then you might take dividends. In order to have dividends to match against those drawings, you need to have profits to do so. And obviously with the downturn in business, economy, etc., if you haven't got profit there, so you might have profits brought forward, but you might not, or it might be a bad loss that uses some of those profits already. So if you don't have profits to do so, you'll have what we call an overdrawn director's loan account, which means that you actually owe the business money. So when your year end comes, if you owe the business money, what does that mean? Well, firstly, it means you need to pay it back within 9 months. Or if you can't pay it back within 9 months, you need to pay the government 32.5% of what they call Section 455 tax. So you can get that back eventually. That's a cash flow tax. But obviously, as I'm sure you can imagine, getting money out of HMRC is a lot more difficult than giving it to them in the first place. So in terms of Section 455 tax, you don't really want to have that problem. You've also got that if you take more than 10 grand in a year and you're owing the business more than 10 grand, you might have a benefit in kind issue. So a P11D issue with another set of taxes linked to it, obviously. And then the final thing, just if your business was to go insolvent for any reason and you're sat there as an asset. So you're sat there as owing the company cash because of this overdrawn loan account. Then at that point, just bear in mind that if a creditor came to look at the money and look at your accounts, they obviously have the right, if they go to courts or if they try to get cash from you in like the legal procedure route, they will have the option to look at the assets and say, well, you need to sell this, you need to sell that. But if they appoint someone and the asset is you and it's you who owes the company money, then obviously at that point you might be personally liable for some of those debts, and obviously no one wants to put their home or anything in jeopardy. So just be really careful with that. And it's really important, if you're using Xero, it's a great tool because it keeps you up to date. So we can log in and we can check that you've not taken too much or you've got enough reserves, or if you haven't, how can we plan around that to make sure you're okay? So just be careful with that one. Okay, lenders.
Just add on to that, Nicola. Graham's mentioned that a liquidator would be obliged to ask for that back via the director's loan account. So if the director's loan account was overdrawn, and just to add into it, and it's perhaps a bit too technical for the conversation we're having this morning, but instead of taking it as drawings or as dividends, we'd perhaps consider increasing the salary rather than but there are ways and means. So if anybody's concerned about any of that, then definitely be having the conversation with us rather than burying their head in the sand.
Thank you, definitely. Okay, then the next one is lenders. So obviously continuing to work down the preference. So not as preference or preferred as customers, suppliers and government, but lenders is next. So obviously we all know about the interruption loan scheme, the bounce back loan. There's been so much all around of that, and there's plenty. We've done releases on that. So if you've got any questions on those still, give us a shout or look at our old videos that we've got on YouTube. But just beware when you're getting these loans from lenders, check the covenants, check the provisions, check the small print, because it might say that your balance sheet has to have so much worth of assets on it. And usually it's all fine, everything ticks along until you're unable to make a payment. And then the bank will get that small print and they'll work through it and see, oh, well, let's check the balance sheet. And obviously if you then have fallen foul of the covenant, you might need to repay it on demand. So just be careful, just make sure you read the small print on those and be careful with them. The next one is asset finance. So if you need a new asset, instead of buying it outright, can you put it on asset finance and split that cost so you're paying for it bit by bit? So you're obviously remembering that there'll be interest and there'll be some sort of charges on there, but it's still better than parting with all that money up front if you've not got that cash but you need that asset. And we'll also talk in a minute about refinancing old assets. So just bear that in mind, we'll come back to that. You've also got factoring. So if you've got debts, you can engage with a factorer. And what they will do, a factoring company will look at what your debts are. So you can either give them your whole debt book, or you can just pick specific debts. And you will say to them that we're going to put a factoring agreement in place. So for easy numbers, let's say you had £100 of debt. They would pay you the £80, for example, up front and say, here's your 80, we'll now chase. And then when they chase that debt, obviously you've got £80 of it, but going forward, they might then get the £20 eventually, and they'll pay you £19, but keep the £1 to themselves as their charge for doing so. So you begin to lose some of the debt, but obviously you're getting cash up front. So bear that one in mind, but a little bit of a warning, I guess, with factoring. Quite expensive to do. So in my example, the pound didn't look too bad, but it can be quite higher. It's quite expensive to do. There's a lot of administration because they need to check that you're following the rules and the agreements they meet with. And it's difficult to get out because if you imagine they're giving you 80%, it's hard to then pay them off to get back out of that situation at the end of it. So if you want to do factoring, make sure you have a chat with us or your accountant or whoever it may be. Have a chat properly through with that, because it's quite a big thing to get into, but it still is an option. And then finally, you've got other lenders. So 0% credit cards, Tesco.com, Wonga, crowdfunding. There's a whole host of people out there that are obviously alternative lenders other than just the normal banks, assets, etc. Okay, so we are getting towards the last few. So these are less preferred really, because they're more sort of tied in, but assets and investments still worth talking through. So an increased value of assets. Do you own a property within the business, or if you were looking at personally, do you own a property that if you need cash, has that property increased greatly in value and you could remortgage it to get some cash out of that property? Or could you increase the return on your assets? So a really common one here, are you currently letting out an asset, renting it out, or are you a hairdresser that's got rent a chair? When did you last put the rent up? When did you last look at where you were at and look at, is it still viable? Should you be lifting that? So obviously inflation has lifted, although slower, a lot. We've all had rates lifts about business rates, council tax, etc., etc. I've seen tons of customers where their rents continue to rise, but have people always necessarily pass those on to other people who are maybe sub-rent letting from them? So that's worth considering. Exploiting an underused asset. So in a building, have you got a room full of cardboard boxes that you need to, that you don't use? It's just sat there redundant. Could you use that room for something else? Could you rent it out to someone as storage or as another office? Similarly, if you've got machinery, have you got a piece of machinery that just sits there, you barely use it? Could you run a sales campaign to get that machinery used so that you're actually doing something with it and you're making the most of the money? And finally, the disposing of assets. So if you've got any assets you don't use, they're just sat there redundant, doing nothing, and they've got a bit of value in them, you may as well sell them and get some cash if you're not going to be using them in the long term. So that's something else worth considering. So those are your assets. Investors is our penultimate option. So investors is quite tied in. So if you've got existing investors, you might go to them, and so it might be yourself, it might be other shareholders that you work with, but you might go to them and say, look, we're going to look to increase our share capital. Why would you do that? Well, if you increase your share capital, lenders look more favourably on it, because if you've chosen to invest some more of your own money into the business, a lender would look at that and be like, oh, okay, well, they've obviously got faith, they've chosen to invest some of their own, and it just allows you to be looked at more favourably by them. And then the alternative is new investors. So if the existing investors don't have the cash or don't want to do any more at that point, what about new investors? So it might be that you've been talking to someone else and you could consider merging and they invest in your business. It might be a business angel. It might be, you know, a business owner who's sort of mentored you, who might have some spare cash and want to help out. Just remember that obviously they then have a stake in your business. And also if you're paying dividends, then they have the right to dividends as well, subject to share rights. So if you're looking to do either of those, feel free to have a chat with us or financial services, sort of a broker. So they are both still options. And finally, family. So it's quite common that people will turn to family members for a loan, but just be really careful with it because it's not always successful. So the last thing you want is obviously an argument over Christmas dinner about who owes who money, and they thought they'd have their money back by now. So if you're going to do a family member loan, it's worth putting in place some form of agreement just so you know you owe the money and the business owes the money, when it will be paid back. And again, build that into your cash flow, but just be really careful with that one. Likewise, yourself. So if you're feeling the need to put cash into your business, then you're obviously putting more money through, but you're sacrificing money that you've previously personally earned. So you've gone out, you've earned that money, and now you're re-injecting it back in. So just think about why you do that and be aware of, is the decision coming from the head? Is it just short term? Is it just because someone's going to pay you in a week and you'll get that cash straight back and you're just doing it short term? Or is it a heart decision? And obviously you've put a lot of time into this business, so you don't want to see it fail. But at that point, if it's becoming not commercially viable anymore, you wouldn't want to be out of money personally. It's not ideal. So at that point, if you've exhausted all the rest of the list and you come down to yourself, it would be worth having a chat, pick up the phone and talk to us and work out, is it commercially viable as a business, or is there any other way? Because most of the rest of that list should obviously help get cash flow first, so you should be the bottom option. So that's the family. So there are all the points. So what we would recommend is, it's obviously great to come to a presentation like this to look through different ideas, but then actually take an action. So if you, on the feedback form, we've got a box for you to write down what one thing you will do differently based on what we've just talked through. So it might be putting a debtor system in place. It might be looking at a direct debit system. It might be doing the cash flow forecast to know where you stand first. It might be having a look at the grants on the government website. So there's a number of options you've got, but make sure that you take some form of action so that you continue to evolve that business. Because if not, we come back to the quote, if you've always done what you always do, you will always get what you've always got or less. So make sure you look to take an action, and feel free to ask us to hold you accountable to that if that helps. But thank you very much for listening. If you have any questions, feel free to go through them, put them in the Q&A box. Simon?
Yeah, brilliant, Nicola. I'll just I'll whack that email address for you in the chat box as well. So if anybody wants to get in touch with Nicola, then just send an email and Nicola will answer any questions. I've got some observations from Gordon and Graham that we're going to share, and we've also got some questions that we just need to nail off. So if anybody's got any other questions off the back of that, or anything that they need to take action off, or anything that you need, then just whack them in the chat box or on the Q&A box. You're very welcome, Claire. Put your action on the feedback form, Claire. That's where the magic happens, in addition to the thank you. So Gordon has said, borrowing against your own home is another source of cash, particularly with the current mortgage rates being so low, which generally speaking we agree with, but consider the other things first. Is that the...
Yeah, definitely. So it is an option, and that is a personal option. Obviously, just be careful, because technically if you borrow against your own home and then put it in the business, you kind of ended up coming back to you, which was at the bottom of the list, because you shouldn't have to sacrifice your own home, your own money for that, because you've worked hard to get it in the first place. So do the rest of the list first. But yeah, it's definitely an option. And bit like we had on the refinancing of assets, that property, if you refinanced a business property, like you say, Gordon, mortgage interest rates are pretty good at the moment compared to where they've ever been in my lifetime. So yeah, definitely an option.
Yeah, but from my perspective, the really important thing Nicola mentioned was do it with your head, not with your heart. Because obviously, as business owners, we all invest a significant amount of time and emotional energy into developing a business. And judgment can become clouded when we're in difficulty and perhaps make decisions that aren't thought through properly. So that's for me, that's a really important part. If you're putting your own money in, you need to be making sure that you're doing it with the head rather than the heart, because you're willing it to happen. So Graham's asked a question around the PGs, and I've got a bit confused over the changes, Nicola. So the COVID loans from the bank, do they all have personal guarantees, or?
No, I think we've covered this one, in one of our previous webinars or one of our previous blogs. But basically, the business interruption loan scheme, that one was 80% backed by the government. So be warned, there's the 20% there that's personal backed. But the bounce back loans are 100% government backed, so there's no personal guarantee on that. But yeah, like I say, with any kind of lending, always read the covenants, make sure if there's any form of personal guarantee, make sure you're aware of that before you get yourself into that, because it's something to be very careful of. But that is why the bounce back loans are lucrative, because obviously no personal guarantee on those at all.
No, but so on the bounce back loans, the one that we need to be careful of is if you borrow the money in the company without a personal guarantee, and then you extract it through your director's loan account, all of a sudden by doing that, you've actually created a personal guarantee that wasn't there in the first place, because the liquidator would then have to go and look to get that money back from you because you've effectively loaned it to yourself.
Yeah, correct.
Brilliant, thank you. And then we've talked about business still needs to be more profitable than before to allow for the cost of the COVID loan, which definitely, that's again, we agree.
Yeah, profit. We're on Tuesday. We're going to do another session on profit. So this one's obviously around cash. So yeah, completely agree. You need to make sure you're able to pay it back. So the cash flow forecast helps with the cash side of that. But there is the profit that obviously needs taken into account. So stay tuned for part 2.
Brilliant. And that link for part 2 is in the chat box. So if you click that, you just have to register for it, same as what you did for this one, along with the feedback form. Mark has asked, would it also be a good time to sell more to existing customers rather than spend time and money on chasing new leads?
So again, this is an area we will cover next week. But there's a lot of different views, obviously, but even within your normal business, even when we're not in coronavirus, looking at your existing customer base and what you've got there, how can you better support them? That's always a chance for, well, upsell, as you've called it. That's always a chance to look at where your money is, because obviously if you've got someone who's already buying from you, and you've proven your quality, you've proven your worth, and then you notice something else. So I had a conversation with a guy previously who he was going around doing site visits and noticed stuff. And we had a discussion that they wouldn't necessarily know that. That's his expertise. So by him saying, oh, did you know this isn't regulated or this isn't done in the right way? He's sort of explaining something, and then he would get extra work from that as well. So definitely an option, yeah.
Excellent, thank you. And then James has asked, I provide serviced spaces for businesses, serviced office spaces for businesses. How do I grow if I'm at maximum capacity?
Okay, so there's a few options there. It might be that so we talked about the customers and where they're paying. Is there anything that you can do? Are you getting the most out of that asset? So for example, we talked about the return on assets. Could you look at increasing the rent that you've got there? Could you look at getting more property? But when doing so, just make sure you think about the goal that underpins that business. So whatever your business is, what goal underpins it? Is it to grow? Is that your goal? Or is it to support or to service people? So think about the goal that underpins, but you could look at basically getting more out of what you've already got, or going and getting more assets and doing more with that.
Brilliant, thank you. I'm conscious of the time. We've got 1 minute to go. I've got a feeling we're going to run about 3 or 4 minutes over. But just to answer these last few, Richard's asked, how do I do a cash flow on Xero that includes VAT?
So personally, I actually don't think, as much as I love Xero, Team Xero, I actually don't think that the cash flow function of Xero is that great. So we'd recommend the spreadsheet to get started. There are different apps and new software that is continually coming out. So there's Fluidly, there's Float. They're different software that you can do a cash flow on if you prefer to do it in a piece of software. Simon, you've done a bit of work with those, haven't you?
Yeah, Float and Fluidly are the two that are there in the market. There's a whole webinar on both of those pieces of software in their own right. But if it's something that you want to look at, they will gladly have that conversation with you, Richard, and show you how they work, and play with it and see whether it gives you the information that you want. Next up, are face-to-face meetings dead?
Well, at the moment, it looks like it. But for the future, my view is probably not. It's one of the main things I miss of lockdown. I miss the face-to-face meetings. So I would say most people have now adjusted to technology, to Zoom, to lots of different video conferencing. So I think from talking to customers, I get a feeling that Zoom will be used more, because obviously if I meet someone in London, why would I do the train there and back and for 20 minutes or whatever catch up, whereas I could do a Zoom and jump on. So I don't think they're dead. I think the meetings will change going forward, but I still like a face-to-face meeting as well.
Thank you, Nicola. And then last question from Laura. Is now the right time to increase prices?
Great question. That will roll in nicely to next week's session when we look about pricing, profits, your business sort of from the profit angle as opposed to the cash. So we will come back to you with that one.
Brilliant. It's almost as though I teed that up to be the last question, Nicola. So we've now been through the questions. I'll just check the chat box to make sure that nobody else has sneaked any in. No, they haven't. So that just leaves me to say thank you very much to everybody that came along and have participated. Some great questions in there. And of course, say thank you to the wonderful Nicola for prepping the presentation and sharing. I think there was 21 different ideas, at least, of sources where we can get extra cash or retain cash in our business. So a huge thank you. Is there any closing remarks, Nicola, anything you'd like to share before we disappear?
No, I was just going to say thank you very much for attending. If there's any particular questions, obviously on the feedback form, there's tick boxes of if you want any of the forms sending out. But if you've got any particular questions or specific to your business, feel free to pick up the phone and give me a call or email me where that link was, and I'll obviously help you.
Brilliant. So to email Nicola, that's nicola@greenstones.co.uk. And thank you very much. And it's time to say goodbye. Bye-bye.
Perfect. Thanks very much. Bye.
Bye. Bye-bye.